Welcome to the Galileo Ventures podcast. For this section, we are joined by two great guests who are also our very first sponsors. So thank you very much to our first sponsors. We are joined by Toby Eggleston, tax partner at Herbert Smith Freehills, and Claire Thompson, partner and co-head of venture capital. Welcome to the podcast.
Thanks, James. Thanks you. Pleasure to be here.
Thanks for having us.
Before we get into things, it'd be great to have a quick introduction from both of you. Tell us a bit about your background and why you're doing what you're doing.
Sure. So I co-head our venture capital practice for Australia, and I'm also an M&A lawyer. I work with founders from idea through IPO and beyond, but the reason I do it is because I find it really energizing working with entrepreneurs, to be honest. I love the passion that they bring. I love being able to help them on the journey and see them grow and develop through multiple raises and stages of their companies.
Thanks, Claire. And Toby, how about yourself? Tell us a bit about you.
Thanks, James. Tax partner at HSF, have been working with the sort of startup ecosystem for quite a while, was heavily involved in drafting and assisting the government and then the ATO in drafting the employee share plan rules and standard form docs that came in 2015, and have acted along the way at various stages. But it's very interesting and, as Claire said, energising working with young entrepreneurs in helping them develop new businesses.
Now, we'll jump into our first topic. But before we do, Hugh, did you want to ask anything?
Well, I think for our viewers, those who are listening, the audio-only version are missing, of course, the most valuable part, which is the facial reactions, but also the work-from-home backgrounds, in that we would like to highlight that the machine in the back of Toby's video is not a guillotine, and we're advised that it is actually a rowing machine. So just for those who have the extra joy of watching us via the video format, you get that extra little, tidbit cookie.
Rarely used.
Really?
Isn't that what all home fitness machines are about? Something, Peloton,
Yeah.
So for our first topic, we wanted to cover startup fundraising for our listeners. Given that both of you have been involved in a lot of different startup transactions, a lot of different aspects of corporate law, I thought it'd be awesome to get some tips for the founders and some of the investors that listen to the podcast. First question, or what I'd like to ask, is based on what you're seeing, tell us about the fundraising climate in Australia this year and what founders and investors should be aware of.
I think it's no surprise that the market is still taking its time to fully recover, perhaps back to the highs of 2020, 2021. Whether we'll ever get there, I'm not sure. But we are seeing plenty of activity still. I would say the majority of activity that we're seeing is kind of at the seed stage and then at the later stage. Anecdotally, we've heard that it can be pretty hard to get a seed round together. A lot of founders are finding it really tough to find a lead, but deals are happening. They're just taking a lot longer than people expect and can sometimes be a bit more of a party round or a bit more of an effort to bring the round together rather than finding that big blockbuster lead who's going to take out more than half the round. So we are still seeing deals happen, but they are a bit trickier to pull together. At the other end of the market, we are seeing some activity with larger companies undertaking probably more complex transactions, so things like large-scale secondaries or founder sell-down, M&A as well. So we are seeing activity there. What we're not seeing a lot of at the moment is that sort of blockbuster Series A or Series B that might have been a bit more prevalent over the last few years. We are seeing a few deals get away, but it's certainly a lot harder than it was.
Yeah. Are you finding that Series A has fallen off a bit of a cliff? So anything above Series A onwards?
A little bit. We're seeing people do a lot more sort of bridging or C plus or C1 rounds at the moment. I wonder whether that, a lot of this is just nomenclature, right? I suspect for many people, though, Series A comes with a lot of expectations around size of your company and what you've achieved, and also, a lot of those sort of milestones. And people don't want to come out and brand their round as a Series A because they don't feel that they're at that level yet. That's certainly, at least sort of anecdotally, what I've heard.
I was going to ask one question for you guys was, What are you seeing as far as competition for deals at the moment?
Yeah.
I mean, there's suddenly obviously been a drop-off, I would say, in the enthusiasm for angels.
Yeah, I was asked this yesterday when I was giving a presentation to some students, and I think probably reflects a lot of what Claire said. Like we get approached a lot for bridge rounds, and certainly to lead a bridge round, everyone is indeed looking for a lead. Feels like everyone will tell you that they're oversubscribed, but no one will lead, and you sort of go, I'm not quite sure it should really work that way. But as we know, Australian VCs in particular, or Australian investors, I should say, can be a bit like lemmings, and there is certainly a bit of that sort of crowd follow mentality that happens. So we've definitely seen a lot of those bridge rounds. Still seeing a lot of new stuff coming in. I would say there's a period where, sort of early in this year, I'd say broadly the quality of the new investments and things that we had coming in was lower than we probably have had in the past. I think there was a period where we see a lot of deals that are like, oh yeah, that's really interesting, and it felt a bit, at least based on our deal flow, like it's sort of maybe a combination of the market quietening off a little bit or the uncertainty flowing through, that we saw a lot fewer exciting looking things. But I think that's sort of turned the corner, it feels, in the last quarter or so, as it feels like at least there's a little bit more confidence in the market. Albeit we are definitely still seeing a bit of that mismatch of where I think often the founder expectation of round sizing and valuation hasn't necessarily reset as much as the market expectation of valuation and round sizing from those sort of heady days. And so I think there's still a little way to go on the founder side, I think, to realize that perhaps it is indeed not 2021 anymore. And simply putting AI in your pitch deck does not suddenly make you an AI company.
Yeah. I think the only other thing I'd say is we haven't seen, perhaps it's more for Claire, but I haven't seen a huge amount of sort of structured deals with aggressive terms. There was some reporting in the various press about a month or two ago that there have been participating prefs and multiples, or certainly pay to play, Ryan Breslow Bolt style, but in the US. But I haven't seen that much of it in Australia.
No, we haven't seen it. I don't think I'd expect to see it at startup stage. That's pre-seed and seed and Series A. I'd expect to see those aggressive deals in late stage financings where they just don't have enough traction to justify the valuation. And I think one of the things that I've noticed in the US is you've had a huge amount of unicorns that were crowned unicorns. You passed the $1 billion valuation over 21 and 22. The amount of new unicorns crowned in 24 is basically nothing. Apart from a few AI companies, it's zero outside of AI. And so it begs you to wonder then what's happening with all these unicorns that are just sitting there. Some people have started to call them zombie unicorns. Others have wondered when they'll get their valuations redone.
Surely they're horses with sticky tape to stick the horn on, right?
Well, I think we need some new terminology here, maybe. What do you call it? Horses with sticky tape on them.
Donkeys.
Doesn't quite ring. Donkeys. Yeah, donkeys. But, I think everyone's trying to avoid the revaluation part, so they're happy to take a hit on the multiples of preference stacks. And so I think that's been happening. One of the questions I really wanted to ask both of you, actually, was what are some of the terms you are seeing right now? What do you think's market? Have you seen any terms change? Anything that's markedly different from a couple of years ago?
Yeah, I don't think we have really. So I would say the majority of rounds that we see are classic one times non-participating liquidation preps, especially kind of early stage rounds. The majority of pre-seed, I would say, we see is all on safes, and that's perfectly fine. But we're not seeing participating preference. We're not seeing multiple anything above one times. We will occasionally see warrant, particularly where there might be a down round scenario or a more complex. But again, I would say that is very much a minority of cases rather than the majority. We have seen a couple of cram down transactions or pay to play type arrangements, but again, that is much more tending towards a distressed situation, really, rather than the norm.
The one other thing that has been popping up is in relation to secondary transactions where the founder or early investor / employees are selling down. There's been a push from the leaders of that round where they're buying the secondary is for those shares to convert into the same class as the primary at the time. that is probably reflective of their awareness of the risk of the valuation drop between ords and prefs. That creates some interesting tensions, obviously, between existing investors, but also some fairly technical tax issues that can crop up. But it has been interesting just to see either that awareness of trying to push full conversion is a bit more prevalent as part of the secondary, or requiring that there be a significant discount on the ords.
And I guess to ask you and Toby as well, like, in terms of the makeup of investors you're seeing typically in these kind of deals, like, have you seen a lot of change happen in that?
We are still seeing some of the US funds be active here, but maybe not quite as much as they were a couple of years ago. The big change, I mean, the Australian funds are still doing plenty, but the big change I think that we've noticed is a lot of funds out of Singapore coming into Australia.
Yep.
That is because there are a number of funds raised, perhaps to deploy into China, but due to all of the change that's happened there, they've looked further afield for investment opportunities, and Australia works really well, similar time zone, seen as being quite fertile ground for investment. Peak 16 has done, I think, 2 or 3 deals this year. We've seen Price Suspensions do quite a few as well, Jungle Ventures. So, yeah, I think that's probably the biggest change, is really the interest from Asian investors in Australia.
Yeah. I think as the Australian market matures, we're starting to see the global competitiveness of the deals and companies coming out of here increase significantly. And that interest is, I think, a good signal for us to see that a lot of the companies coming out of here are actually competing against companies coming out of Singapore, coming out of the UK or US that are trying to enter this market. And it's great to see that now in this region, there's quite sizable firms.
Yeah, I mean, I think it's an interesting lesson for founders, though, insofar as often, certainly the founders that we talk to are looking at US funds as kind of the logical partner and things like that. I would say it's more often that we will actually suggest or guide the founders towards looking at the Asian or the Pan-Asian funds instead of them actually actively doing it in the first place. So I wonder when, maybe as more of those deals get announced and things like that, they'll sort of start to be more of a drive from the founder side.
Are you finding the change in the mix of international VCs coming into Australia this year? Have you seen any changes in that area?
I'd say it's quite consistent, actually. I'd say still the majority of cases, the deals we're seeing are led by an Australian VC, and then probably equal representation between Asian and American VCs.
Okay.
I'd say
50-50.
similar.
That's interesting.
Yeah.
Oh, okay. I would have thought it'd be like 80 US, 20 Asian, but if it's 50-50, that's surprising to me. Next question is, what are your top tips for founders when raising capital?
I'd say probably the number one tip we always give our founders is the deal is done in the term sheet. So make sure you read your term sheet and you negotiate it. There's a lot of jargon in the cap raising space, and obviously investors do it all day, every day. Whereas for founders, if it's their first cap raise, they're probably Googling what is a liquidation preference, and it can be overwhelming, all the jargon. So there's, founder vesting, there are terms in there that actually can bite. So it's important that founders understand what's in the term sheet and are on board with it before they sign. A term sheet obviously can be negotiated and should be negotiated if there are terms in there that are not right. And you should be getting advice at that point in time, because it's quite easy, if you've got a 4-page term sheet, it's quite easy to make minor changes to that document that reflect the commercial deal, and then make sure everyone's happy with it, and then you sign, versus just sign something quickly and think, oh, we'll sort it out in the long-form documents. Because although a term sheet might say on the top of it, legally non-binding, actually that represents your handshake deal. That is the basis on which your investor will go and get their approvals. That is the basis on which everyone will draw up the documents. And so if you're trying to reopen the deal in long-form transaction docs, it chips away at time, it adds cost, and also it starts to erode the goodwill that you've established with your investor. Although you might have said, oh, we'll work this out later, people might feel that, oh, well, we agreed one thing and now you've come back and you're changing the position. So we always advise founders to really be on board with the term sheet before they sign it. That's really our number one tip.
Although, of course, you don't need to negotiate any Galileo Ventures term sheets. They're all perfect.
There'd be no need, I'm sure. Absolutely. The most founder-friendly terms available, I am sure.
Just like every other VC.
That's right. And I think from there, like the next bit of advice I would say is to try to keep your round as simple as possible. The first price round that you do will generally be the best deal terms that you will be able to achieve. So the way that it works, you've got 3 key transaction documents on any deal. You've got your constitution, you've got your shareholders agreement, and you've got your subscription agreement. Your shareholders agreement is the key doc, really, that will live and breathe alongside the company. And the terms that you put in place in your first round really should be terms that are good enough to last you all the way through to exit. Every time you do a round, they'll be reopened and little amendments will be made. You know, an extra investor will have a board seat perhaps, or an observer right. They will also want some small change here or there. But if they're set up correctly the first time around, they should be able to be just minor tweaks along the journey. But those tweaks are always going to be things that an investor needs for their own approvals. Those docs are not going to become more founder friendly as you go. They're only going in one direction. So set it up simply and set it up in a way that is as friendly to the founders as you can muster. And then that will set you in the best stead to try to stick to that position through future rounds.
Great. Thanks, Claire. That's interesting. Good tips. We'll definitely take that to heart in the show notes as well. Toby, do you have any top tips for founders when fundraising?
Speak to Claire or Elizabeth as early as possible. I think we're always happy to have that discussion early on and review a term sheet and provide guidance.
Yeah.
I mean, I got to echo that. I think the amount of founders that we meet that don't ever get someone to review the term sheet and they go, I'll just get the long form docs review. And I'm always like, look, you know,
Or things come up as a surprise to them in the long form docs and you're like, well, this was actually in the term sheet. I got to echo that. I think some founders think the term sheet's just the non-binding handshake that doesn't mean anything, when actually it does mean a lot. When you talk about, I guess, getting a law firm involved nice and early, term sheet stage, everything else, how, you know, other than, of course, picking HSF first, you know, naturally, #sponsored, but how would you as a founder, or how would you advise founders to go about picking, you know, the right law firm for them? And, you know, does that change over time? How does that change? You know, what should that decision matrix really look like beyond, as I said, of course, always coming to HSF first?
So the advice is simple. Pick HSF. We're the only law firm that you need.
Great advice.
But if we happen to be conflicted or there was some reason that you didn't want to do that, I think the key thing is to choose a law firm that does venture deals and does volume. Really, there's about 5 firms in the country that would apply to, I think. Don't just pick, you know, your cousin's next door neighbour because they went to law school. This is actually really important, and you'll actually save yourself, although you might be walking into a big firm on Collins Street or in Circular Quay in Sydney and think, oh, this feels expensive. If you get lawyers who actually know how to do these deals and do volume, it will save you money because they can do things much more quickly and efficiently than people who don't really know what they're doing. So, and they'll actually look after you and be able to say to you, don't push that point, all investors need this, this is why, versus someone who might be less experienced, who might have a big fight about something that is just so obvious that every investor will need and is really no disadvantage to a founder. So choose those who've got experience. And if you don't know, ask your founder mates probably who they've used and who they liked. I would say that's probably the best starting point.
Yep. And a quick follow-up on that is costing. So one of the things that I think a lot of the founders ask me, they go, oh, how much should this cost? For a pre-seed deal, just general terms, what do you think it should generally cost for a fairly straightforward deal, pushing aside sort of the really complicated ones?
Well, if you're doing a pre-seed safe, and so you don't need to negotiate a shareholder's deed, I would think that should be costing you, I'm guessing, sort of some 10,000.
Yep.
Well and truly. Probably a lot, some 10,000 actually. And then for a seed round, it does vary. So the key variables would be how many investors you're bringing in, how many safes did you sign up in your pre-seed round who you're now converting.
In different terms, nothing worse than the stacked safes, right?
Were they all the same? Hope so.
Yep.
but maybe not.
Not these days.
Usually not, yeah.
And, how they all got side letters that are different, we now need to incorporate into the shareholders deed.
Yeah.
So there's a lot of variability. But for a seed round, and at its simplest, if we're talking 1 to 2 investors, no saves or maybe one to two saves, it could be sort of somewhere in the 10 to 15 area, but you're probably more likely in the sort of 20 to 30K, I would say, for a simple round. And then upwards of that, as soon as you've signed up more than 10 saves, you're into real complex territory. And as soon as you're bringing in more than about 5 or 10 investors, you're into complex territory. So, yeah, it's that complexity that adds cost.
The other thing I'd add is the build-up of legal debt that has arisen over the life, like the longer you go and have not addressed things, that just tends to add complexity and issues. For example, if we've seen transactions where they already have, because they were doing a share plan early on for their employees rather than an option plan, they already breached the 50 shareholder rule. And so fixing those issues up just adds expense along the way.
That's a good tip. I mean, my advice is always to say that you've got to remember that the interests of a wonderful firm like HSF is ultimately getting the bill for the IPO and very late stage work. So, we know that Claire and Toby do the early stage work for, I wouldn't say fun. Don't know if I'd ever say that legal work is fun, but I'm not a lawyer. But certainly the business model and incentive is much more stacked around building a relationship with you early such that you'll come to them as a preferred partner later on, which I'm sure that they can attest to many stories in which, that's happened as they've proved along the way, as Claire said,
It's
they've been a good partner.
Although it might jack up the fees when we've got to sort out these incredibly complex scenarios, it's definitely not what we want to be doing. I'd much rather help you avoid the issues by spotting them early rather than have to fix them later.
Yeah.
But yes, it is very much built around building a long-term relationship.
All right. Thanks, Claire and Toby, for our mini interview on startup fundraising. We will catch you next time.